Let's get some insights on the news that's shaping markets. For that, we want to welcome in Jeffrey Small, president of Arbor Financial and partner at the Retirement Income Source. Jeffrey, thank you so much for joining us this morning. All right, let's talk about where we sit right now. We're churning around the flat line. Got a lot of earnings to get through. This is like just the flood this week. And among those that are coming is big tech, right? So you say that all-time highs aren't necessarily a bad time to buy. What do you mean by that?
No, all-time highs are not necessarily a bad time to buy because right now the market sentiment really is neutral. We're not really in overbought territory, and that's kind of where the market is today. I mean, if we were feeling euphoric and there was a rational exuberance in place and trading activity, we're just not there. This is the most hated V-shaped rally in history, and there's $7 trillion sitting on the sidelines, and we're in neutral market sentiment territory. And so earnings are really what's driving the tech side of the equation this year, as opposed to valuations. And the acceleration of those earnings is going to continue. And that means these prices are going to keep rising. Therefore, Diane, it's okay to buy at this stage of the cycle. There's nothing wrong with that, especially with the companies that, let's say, are the premier tech that aren't significantly overvalued. So buyer beware, right?
Okay. Jeffrey, let me ask you this. You said this is the most hated recovery. Why do you think that is?
Well, because Liberation Day was supposed to be the recession. So we've been living since 2022 with the recession that never was. The Fed called it in 22. There's going to be one. They said there's going to be this one. The Fed's hypersensitive on inflation. Everybody's waiting for a pullback. And so there's lots of people have missed this rally. And it's a shame that's happened because we are living right now in the fourth industrial revolution where 95% of the human race is being outsmarted by a chip that NVIDIA is making and is going to revolutionize our economy and what's going to happen in terms of the efficiencies and profitability of some of these largest tech companies. And we are now just starting to see that.
Okay. All right. And Jeffrey, let me ask you this. You have talked about sticking to fundamentals. And let's talk a little bit about big tech because we have several members of the Mag 7 coming this week. We already had Alphabet, Google. What's your outlook when you think about positioning within big tech now?
Well, I think that big tech is a great thing to own still. There's lots of room to run. And I think we've got a sleeper. You mentioned it, Diane. We've got a sleeper and a potential great stock to own in Google because it's trading at 20 times earnings, where the rest of tech is really trading at 29 times earnings. And I think Google is going to be the sleeper pick here the next 12 to 24 months.
Okay, so the next 12 to 24 months for Alphabet, Google. You also like Meta. Now, that has been an outperformer in the group. Why do you still like it, and how much more room to run does it have?
Well, I think you could see a 12-month price target of 15 to 20% above here. But, Meta has blown the door on earnings for, 15, 16 straight quarters here. And I expect them to do the same. They're projected at $5.84 a share. We see them getting close to $5.99, or maybe $6. Their ad revenues increasing due to the AI placements they've made, and they're starting to experience monetization in that sense. And so, granted, they are 75% of the ad space domestically here between here and Canada, and so that trend will continue. But you definitely want to own Meta. Their fundamentals are phenomenal. When I was on the beginning of April with you, I said, Diane, some of these stocks like Meta, NVIDIA, Tesla are never going to be this cheap again. We may never see them dip below here. And that's where we're going, and that's where we are presently.
Let me ask you this then about Tesla, because that is such a lightning rod topic when you bring it up. You have serious critics and serious believers. You have it as a pick. Is it about where it sits right now, and you see further value from here?
Well, I do see further value from here. And so regardless of metrics, right, regardless of multiples, as the robotaxi expands and as the robot comes online and that gains more traction and the taxi gets into more cities, we're going to see the price rise commensurately with the expansion of robotaxi. So to me, it's a no-brainer. Is it a trade right now? Yeah, it seems to be stuck in a trading range. But look, this is a buy and hold. This is not something that you're going to see go up, 300% in the next 12 months.
So is this over the next 12 months, since it's in this, it's been in this range recently, Do you see this like you see Meta? Obviously, it's a different story around it, where you see 15 to 20% over the next year, or is this really a long term? You got to have a 3 to 5 year time horizon on this one.
You know, I think the stock price is more correlated today, and this is kind of a goofy thing to say. It's more correlated to the expansion of the robotaxi. So if we're sitting here, you know, in 20 cities by the end of next year, or 25 cities by the end of next year, you're going to very easily see the stock price at 500, regardless of the fundamentals. But Diane, don't discount the fact that Tesla sales will begin to pick up next year on the automotive side, because really this isn't an automotive company. This is a tech company.
Okay, that's fair. I know that some argue that, and I do think that's the future. But you know, there's something to be said for valuing it where it is right now, and where, you know, at least the next 12 months looks. I don't want to spend too much time on Tesla because I want to get a final thought from you on tariffs. They are starting to bite within some companies. For instance, UPS flagged tariffs, right, because of the de minimis. How do you think about them as it relates to their impact to big tech, Jeffrey?
You know, really from an infrastructure standpoint, as they build out the data centers, and they're spending hundreds of billions of dollars on this expansion in AI. And so there will be a little bit of a penalty there from the tariffs, because a lot of that stuff will come from offshore. And so, you know, I don't see it affecting the actual business models of Google or Meta. Of course, Tesla had a $300 billion expense, you know, this year for tariffs. That's going to continue. And the tariffs are here to stay. They're going to become part of our life. As far as what gets passed down to the consumer, you know, maybe 1/3 to maybe 50% of that tariff gets passed down to the consumer. So what does that mean? You know, 3-4 turns or clicks on a 1/10% on inflation. Not very much, just a bump. But it's not going to cause us to go into recession.
Okay, all right. We will leave our conversation there for today. That's Jeffrey Small, partner of the Retirement Income Source and president of Arbor Financial. Thank you, Jeffrey.